Welcome to Investment Literacy Coach. I'm Mukund, and today we have Kris. And Kris and I have been interacting via Twitter over the last few weeks. He does a very interesting and a different approach, and he's got a YouTube channel. Although his Twitter is where I follow him, I've seen some of his videos as well. YouTube is a place that he spends quite a bit of time talking about his approach, talking about strategy, talking about investing. So, Kris, welcome.
Hey, Mukund, thanks for having me on, man. It's finally good to actually hear you and see you face to face. We've always interacted via our calls on Wiseman and sometimes on Twitter, but it's always nice to put a face to the voice, you know? So that's always it's definitely a new experience that has only been like more popularized over the last 5 years, thanks to COVID, of course. But I found it kind of interesting how now it almost humanizes us, whereas before it wasn't. Like, I didn't think that we would adapt as much as we could have,
Mm,
prior to COVID. Zoom was around before COVID, but it just didn't feel as natural. And now I feel like sometimes Zoom is actually more natural than in-person meetings. And it also opens up the horizon on how many people you can actually contact, and the feeling that, like, right now, even though we're in two separate time zones, it doesn't feel like we're that far away. I think that's the magic of Zoom and these newer technologies that are out there. So
I
yeah.
agree with you. The interesting part is I have a few people that I interact with on Zoom that are just two streets away, right? Just a
Mhm.
couple of streets away. But we
Yeah.
prefer Zoom to going down to the coffee shop, which is a 15-minute walk. And then after that, you go get the coffee. Sometimes you have what they, but anyway, but it's great to have you on board. Obviously, it's
Yep.
delightful to talk to you about investing in stocks. Let's start at the top. What got
Mhm.
you interested investing in trading?
Mhm.
Why did you start and how did you start and when did you start? Let's go with those first.
Okay, so this is going to sound interesting, but believe it or not, it started with the tech bubble. My dad had lost a lot of money during the tech bubble, right? And
Of
so
2000?
of 2000. Yeah. This is
Wow.
like way back in the day. Now, the thing is, I was just a kid at the time. I was in high school. And one of the things was, like, my family's life situation had changed dramatically. Like, we were doing well financially, and then when you go from well financially to not so well financially, even as a kid, I was curious. I was trying to figure out what the hell happened. Like, why did this happen? And based on my dad's lessons, I was able to understand, like, okay, I saw what happened. He ended up getting FOMO'd. A lot of people told him, hey, I've made this money in the stock market. So then he was like, oh, well, I could do that. Like, I could do a little bit of extra income so that this way, like, I can take care of my family. And so a lot of people were getting into the stock market, and everyone was just buying up tech companies. Like, he didn't even know what he was buying half the time. But, if someone said it was a good company, he would buy it. And it was very interesting because, you know, as he was doing that, I was learning, like, okay, what is going on here? So when he lost it all, I was very curious. So that's when I started to realize, like, okay, there's such a thing called valuation, where you don't pay for things that are overvalued, right? Like, there's something called profit and loss, and you shouldn't invest in companies that don't make money, right? So these are like early life lessons that I learned way back in the day. And then, of course, as I grew up, I was in college, and believe it or not, in 2006, we were about to buy our first home. And I remember we kept getting outbid, and a lot of people were buying homes at the time. My family, we were okay financial shape after the whole 2000 issue and whatnot, and we had just finally recovered. So we were about to buy a house, and once again, like, all of our neighbors were buying houses, and some of it just didn't make any sense because it was like people that were making way under what my father was making, yet it was like, how are they affording these houses?
Right.
So that's when I was a little bit more curious. And by that time, I was in college. And so I actually warned a lot of my college friends at the time. And I said to them, like, look, I don't know what's going on in the market, but this doesn't seem normal, with the house prices going up so much. And so I actually wrote a really long email, and all my friends were like, bro, you're in college. Like, have fun. Like, why are you being so pessimistic?
Yeah,
You
chill out
know,
a bit. Let's go drink
yeah,
some
now
beer.
Yeah. Now, here's the thing. I didn't know about mortgage-backed securities. I didn't know about how speculation worked on Wall Street because I was still in college. My primary major wasn't even in business or finance. It was around pre-med. So, when you're Indian kid, your dad parents are always pushing you, no,
Engineering,
beta,
medical.
beta, medicine, and never it's a recession proof. I'm like, I suppose that works. So I originally went that route, and I just didn't like it. And then I did graduate, but then I had to like really rearrange my career situation. So that's when I joined the military. I got a little bit more additional training. So I still have a clinical background, and I also have a technical background. The one thing is computers always interested me, networking, IT. So I got MCP when I was still in high school. We had a
Wow.
program for that. Yeah, but once again, the dot-com bubble made my parents, like especially my dad, very leery. Like he thought that maybe this was not the future. So,
Mhm.
parents are always going to put you, like they want the best for you, so they're going to push you into a direction that they think is the one that's going to see the most opportunity. So for me, it was medicine, but I wish I hadn't gone that route, and I just wish I had focused on what I really liked, which was IT. But that's typically what happens. People pivot. So after that, I ended up in the military. I got out of the military and I started working in a hospital in radiology. I was a radiology tech. I did X-ray, CT, MRI. I got all the certifications for
Wow.
it. And yeah, and
Man,
one of the
you've been
things
around the
was,
block quite a bit.
yeah, and then after that, it was interesting because the every time one of the PAX administrators, they would call out, they'd say, "Oh, Kris, you're a young guy. You know about computers. Go figure it out." And I would take a little more leading role in everything, and I ended up excelling at it. And then eventually, I got hired as a PAX administrator, and now I actually do system admin roles. I do a lot of implementations. So yeah, and I love it. I love it more than I like the clinical side.
Is
Now,
most of your
yeah,
work local and hyper local for small, medium businesses, or is it for large companies, or is it both?
yeah, it's kind of for both, but I work primarily with hospital systems. So
Yeah.
I work for the hospital system that I'm currently been employed with for the last 5 years. But I transitioned from a clinical role to a IT role. So that's a big change. But what's actually really good is that I'm one of the few people on the IT side that has a clinical background. So when it comes
Right.
to yeah, so when it comes to in implementing any workflows or any new projects, I'm usually the one that giving some really good advice. I'm usually the one that they're asking to like train some of the other staff because they're like, okay, you've been in both shoes. Like you've actually been at the end user side and you've been an end user and you've been on the technical side. So it's just
Good.
it's
A
a
unique
very,
niche.
yeah, exactly.
How
So
did you get into investing then?
so, over time, it was just one of those things that I was always interested in. Like, okay, trying to figure out why companies were bought, why companies were sold. Um, and eventually, of course, I'm greedy. That's just how it is. I don't want to say greedy. I'm just money minded. I'm always trying to figure out ways to make more money and hustle. So one of the things was it wasn't just, okay, I'm going to just follow a random person and buy the stocks that they tell me to buy and hope for the best. I kind of want to know, like, why is a person successful? Why are they not successful? What are the strategies that they are using to get ahead of the market, right? um so all those things led me to like different ways of investing. I have probably 3 to 4 core strategies that I've developed over times that really work well for me, and some of them it's a lot of them are because I've actually made some mistakes along the way as well. Like
Mhm.
if anyone tells you that, hey, I have 100% hit rate when it comes to investing, that person is clearly lying. There's no such thing. Like the bet
Or they've had only one investment and they're done.
exactly.
Right? That's
I
the
think
only way you can have 100% is if you do one and you do
yep,
that one right. And after that you
yep.
stop and you say no more.
Yeah. And believe it or not, one of my friends actually has something similar to that where he's just been buying Apple since 2010. Like he's like, I like the phone, I like the company, whatever. So he's always been dollar cost averaging for the last
Sometimes
10.
it's that simple.
He's got better returns than I do. And I actually do like a lot of investigating. So sometimes I wonder, like, am I really the guy that you should listen to as well?
So
Right?
how would you define are you an investor? Do you call yourself a trader? What is your time
Yeah.
horizon? How do you go about your work?
So I would say I have three buckets in my investing
Mhm.
style. So I've got a portfolio that's primarily short term, short in nature that capitalizes on volatility. I've got medium term that focuses on company strengths and financials and undervaluation. And then the last one, of course, is potential for super levels of growth that are continuous growth for a long period of time. And I usually divide it up that 50% of my portfolio is long term, about 30% is medium term, and the rest is just more on the speculative, short term trading volatility nature of things that can see an outsized return. So, as an example, when things go haywire in the market and they just make absolutely no sense and they go super ridiculous, I usually have some liquid cash on the side just ready to pound. So, as an
Right.
example,
That's good.
when yeah, Meta was one of my biggest positions last year that just netted me close to 500, almost 500% in terms of returns.
That's
Because
awesome.
when Meta, I remember me and we were talking about this on the Wiseman call. When Meta dropped down to I think the 90s and the PE was in the single digits, I was like, I think a lot of people are not giving Zuckerberg enough credit for the stuff that he's already built, and a lot of the expectations that he'll run the company into the ground by constantly focusing on the metaverse were just a little bit off. And so during our call, I was just like, look, I think that this is a very unique opportunity that you actually have to capitalize on very undervalued companies that's generating a tremendous amount of cash flow. They've overhired, but that's the key. When a business does make mistakes, does the leader have enough of a good mindset to be able to course correct? And I saw that in Zuckerberg. Like, I've seen him constantly be actually a lot more capital efficient in the past than he was in the future a little bit. So I was like, look, he's going to make the ultimate decision. Brad Gerstner had wrote a letter to the Facebook board and to Mark Zuckerberg that I thought was very compelling. The arguments that he was making around cutting some staff, cutting some capex around the metaverse, and and refocusing on the core business. And
Right.
I think that really got to him. And I saw that shift happening all over Silicon Valley, where they're waking up to the idea that we can't just keep hiring without any sort of end goal. And so I felt like it was a very good opportunity at the time. So I got into a lot of my favorite names that were cash flow positive, heavily weighted towards a recovery. And I was actually buying a ton of leap meta contracts, which I still have some of them. I did sell some. I took a little bit off the top to recoup my initial capital, but the rest I'm just like, no, I think Meta is very undervalued. It's one of those companies that's generating a tremendous amount of cash flow. Their business is still running very well. They've got other avenues of monetization that they haven't even really picked up steam yet. So I would say
There
from
was
an
a
invest, yeah,
there was a
yeah.
rumor on Twitter. I don't know how
Mhm.
true it is. A week ago, that said that Meta, since they introduced their own version of the Twitter blue check mark, which is
Mm,
verified accounts, they've had millions of users sign up for it and willing to pay for it.
yeah.
I don't find that hard to believe, but the number that they threw out, I was shocked by.
I think it was like 55 million or something like that, right?
Some ridiculously high number.
Yeah. Yeah. I'm having a tough time believing that as well, but I wouldn't be shocked at it because there are a lot of businesses that they use Instagram as a way to market themselves
Right.
outside the traditional media source. So for them, an $8 a month or $10 a month is nothing in
Nothing.
terms of their P&L,
That's the
you know.
same I found when I was in India. I was in India from 2008 to 2014. I lived in the Bay Area until 2008. Then we went back to India for 6 years. There are businesses that are more than happy to pay for WhatsApp business, even
Hmm.
$10 a month in India to verify
Yeah.
themselves or to make sure because they do their business on WhatsApp. I mean,
Yeah.
that's their business. WhatsApp is their business. They don't do email, they don't do
Yep.
text messages, they do calls and they do WhatsApp. And they think WhatsApp is the best asynchronous platform ever to be able to
Yeah.
communicate with their customers.
Yeah. And now you can integrate your business applications into WhatsApp as well. I think
Right.
the ultimate dream of Zuckerberg when it comes to WhatsApp is to create a very similar clone to something like WeChat, where you have an all-in-one encompassing app where people are going to go to it for a majority of their needs. But the thing is, I
Super
think
app.
what yeah, the super app. But you know what it is when I speak to some people in the United States when it comes to Meta and Facebook, they have a very myopic view of what's possible because they only look at themselves and they like, oh, no one really uses Facebook anymore. Like, and I'm like, you do realize that there's a world outside the United States that's like growing exponentially, and they're all getting on different platforms and applications. And these are just different avenues of monetization outside of just the
And a lot of them, I
US.
don't think even realize that Instagram is a part of Facebook. Some of them do, but not a lot of
Yeah.
them do.
Yeah, that's the other thing too. Yeah. So I think overall that's where you have to be very broad with your investing strategies, and don't just look at a company based on what you're seeing like in face value. Speak to a few people outside of your comfort zone that can give you a little bit more insight into what a business is doing, how it's operating, and definitely do stuff like this, what we're doing, interconnect with people so that they can give you guide. No, I wouldn't say guidance, but give you some feedback on some ideas that you have. And I think that's one of the great things about our Wiseman calls that I've enjoyed specifically.
So tell me a little bit about, you said there are 3 or 4 strategies that work for you. So you've
Hmm.
bucketed into long-term, medium-term, and short-term.
Yep.
Um, how do you screen and scan for companies for the short term, and how do you do that
Okay.
for medium term and long term? If
Yeah.
you look at a opportunity and you say this fits into my medium term, this fits into my short term, how do you do that?
Okay. So the first thing is I'll start by the short term. Most of the time, my short term plays are centered around mean reversion, where when you have a company that gets oversold, you want to look for the opportunity there. Like, why did it get oversold? What are some of the changes that that company can make in order to pivot from that? Is it a sector wide issue, right? That's causing this to happen. So those kinds of things that you want to see, like, is the market just overcautious
Right.
with
That's
how it
the
works?
Facebook
Yeah,
example for,
exactly.
sometime last
Ex
year or sometime a year before that, people felt because of the IDAF issue from Apple, they felt
yeah,
Facebook's advertising is gone. Turns out they had a little bit of a bump, but not horrible bump.
yeah, exactly. Now, here's the part that's going to shock you. Even though it is um a short-term play for me, I would say the best way to invest in it is to do things like credit spreads, where I would typically buy in like I would say enough of a far out call option that nets a decent return, but then also sell call options against that position. But make sure
What is
that
a
it's leaped
decent
out.
time frame?
I would say, but well, to be honest with you, it's the furthest leap that you can think of. And let me, I
Years.
know, yeah, I would say years, like 1 to 2 years. But let me explain why. When you think of options pricing, if you try to time the market, you try to buy 1, 2, 3 months ahead of time, even like a 90-day option, Black Scholes will kill you. Black Scholes will figure out like what the options pricing is and actually not give you the best value for the risk that you're about to take on. Whereas the much further that you go out in the what's that thing called, in the strike, you'll actually see a lot of options mispricing. And that's the key where you can actually benefit significantly by having that mispricing happen.
When you
And
say mispricing, explain that, because obviously the rule of thumb is the more far out the time frame for the option's expiration, the more price you're going to pay. So let's assume the
absolutely.
option expires in 1 week, you pay $2 as an example. An
Hmm.
option expires in 1 month, you might pay $2.50. An option expires in a
Hmm.
year, you might pay $5. An option
Right.
expires in, let's say, 2 years, you might
Hmm.
pay $10. And then what is the mispricing and why does that happen?
So what happens is the further out you go, it's always going to be very hard to determine what the current valuation for the company is. I mean, you think of it this way. If I told you right now, Mukun, what is the weather going to be like next week? You can tell me with a decent amount of certainty what the weather is going to be like based on, what you're feeling right now, some of the stuff that's going on. But if I tell you what's the weather going to be like 2 years from now, you're not going to be able to tell me. But if you had to make a bet, like let's say me and you had to make a bet on it, you're going to give me a number, but that number may not make sense at all. So a lot
Right.
of these high frequency traders and everything else, they'll put out options pricing on LEAPS contracts that, believe it or not, are actually very mispriced. So the potential for a upward move can be very significant, but also the move downward can be very significant also. But that's where you should also do some position sizing, where you don't put enough money in there that you're going to miss it if it doesn't go the way that you're thinking, right?
Right.
So the way that I typically want to do my short-term trading is, if I'm going to bet on something, I'm going to bet on to gain a lot but lose a little, right? I think a lot of people, they miscalculate, and what they do is they take a lot of risk to gain a little bit of money. So what they'll do is they'll sell a covered call, right? Really far into the future, and then the stock just shoots up, and now, you know, they tried to get what, 10-20% return on it, but they lost a 50% return on the stock price that they could have got. So I think for me, I like the other way, the other part of the strategy, where if I have a chance to get a 5-to-1 return, that means that even if 4 of those, you know, bets go wrong and 1 goes right, I'm going to be break even. If 2 of them go right, I double my money. If 3 of them go right, I triple my money. And that's the key, right? So as an example, just to show you what kind of mispricing there was, I'll give you an example. When I was buying my Facebook positions in November, I was buying the $150 strike, call strike, going into 2025.
Okay.
And I was selling the $200 call strike in 2025. Now the premiums that I got minus
Buying
the
150.
right, so the premium that I paid minus the premium that I got, it ended up being around $7-8 per contract for the pair, right? Not per contract. So it was about $800 per. That same options play right now, if I, let's just say, cleared it out, is $28, because now Facebook has gone up so much. Now the entire time that Facebook is reverting back to the mean, which is 150 plus, what's happening is the time value is going down, but what's happening is the premium at the top is actually being eaten away, and the premium at the bottom is actually staying steady. And so what's happening is I'm gaining money the entire time. So right now I was able to 4 or 5x the money, even though the capital that I put up was very little capital compared to what a lot of people would have put up, you know. So some people, they were like, okay, I'm going to take such a big risk. I'm going to buy nothing but call contracts for $150 strike. But if you just bought the call contracts with $150 strike, you would have paid a significant amount of premium, which meant that your break even was probably close to like 175 to almost 200 at the time, if not even more than that. So if you wanted to get the same level of returns that I got, you would have had to have Meta go all the way up to like 300, right? Which, believe it or not, it could be possible. But I found that this, in the short term, is probably the best way to time. Well, I wouldn't say time the market, but play the market, especially when really good companies have gone undervalued. I did a very similar thing to Tesla. I did a similar thing to Amazon. So I usually will look at the valuations where they should be, based on relative valuation, and also based on some of the metrics that I have, and just try to find a price target that I feel comfortable with, and then see if there's options of mispricing, which, like I said, that I could capitalize on and
It's
get some good
very
returns.
interesting. I've not heard of that so far, but as you said, as I was telling you at the beginning, every time I talk to somebody, I'm just absolutely fascinated by their strategy that seems to work. And in your case, it is mispricing of options in the LEAPS specifically, or maybe even longer term contracts, right? Does that
I'll
happen even
send
in
you.
short term?
Believe it or not, short term is actually hard. So I don't buy any short term. That was a mistake that I made a long time ago, where I would try to time the market and buy short term options, because I thought, well, they're cheaper, right? So I can buy more, which means that I can profit more. The problem is, most of the pricing that you'll get in the short term, the risk is already priced in and it's risk adjusted, so that it'll be a very slim chance that you make exponential amount of money with, and it's a much bigger risk too. So
Well,
I'll send
different
you a
people
couple
have
of
different
videos.
strategies. There are lots
Yeah,
of people
yeah,
that I know that only do short-term contracts. Seems to work for
yeah,
them. So I think what I've learned is everybody's figured out what works for them.
yeah,
What you figured out is what works for you is in the long term, the price mispricing that happens, and that's what seems to work. Okay,
yeah.
that kind of makes sense. That's one strategy that works, the mispricing of options, especially long term. What do you do for the medium term, your medium term investments?
So the medium term investments are typically companies where very similar to Meta, where the valuations have gone down significantly, but they're more along the lines of tracking the market. And for those, I just buy the equity outright. So these are things that are, worth just investing in and just holding on to. Also, bonds on companies that are typically not loved. So if you look at, I don't know if you do any bond investing, but I try to do corporate bond investing, and I've actually done fairly well doing distressed bond investing. Have you ever
I have
looked at
not.
that?
Tell us
Okay.
more. Tell us more.
So this is something that most retail investors should not even try to do, not even get involved with. But basically what happens is there are times where certain businesses will, of course, take on too much leverage, or they're in a position where the economy goes in another direction. And so there are negative business impacts in the short term, which makes their credit worthiness a lot lower than what it was when they were
Right.
operating very efficiently. So what happens is the prices of those bonds typically comes down way below par. And so when they drop below par, it gives you an opportunity to buy them at a significant discount. And then once the business starts to recover and gets back into normal, you can actually, use those bonds. And the entire time that the bond is down there, you're still getting your interest payments. Unlike dividend payments, where dividends can be paused, bond payments you can't. So it's almost like you're lending money out to someone. So it's like almost like a mortgage to a company. So as an example, Royal Caribbean cruise lines, during COVID, they had gone down so much because, of course, they couldn't go on any cruises, they couldn't do anything. And as time went on, of course, we got back to normal. Cruise lines were doing very well. They've, in the last 12, 13 years that they've operated, they have tremendous amount of operating cash flow. They've got leverage all over the place that they can use to generate return. And so their bonds were trading, especially Royal Caribbean was close to, I think, 70 cents on the dollar. So for every $1 that, debt that they issued back in the day, those bonds were trading at 70 cents on the dollar, and with an 8% coupon. So you're almost getting a fixed 12 to 15% return. The maturity was in probably like 4 or 5 years. So the maturity wasn't even that far out either. And the company, when I looked at like the cruise lines, they had bookings that were rivaling what they were doing back when COVID was first, before COVID. So if you look at their cash flows, it was like, okay, I see where they are. Like the business is still operating like with a healthy return. The thing is, though, they had taken on a lot of debt to finance that transition during COVID. Now, because they had done that, their main goal right now is to pay down as much debt as they can, right? When you take on debt, your goal is to pay down debt so that this way your operating cash flows are now being diverted from investing in the stock buyback plans or the dividends back into the other side, which is just paying back the debt. So as your cash flow situation improves, what ends up happening is you improve and you can get in, and and basically they pay you back to par. So once it gets reverts back to the mean, you can make a decent amount of money, and also at the same time you can enjoy the interest payments. So yeah, those are the things that I typically do in the medium term. Once I get par value again, I'll decide whether I want to keep it in my portfolio, if I want to hold it for a while. But typically, the return that you get is not sufficient enough for me to hold it long term. The other thing is, though, you also are going to pay taxes on the interest payments that you get as well as ordinary income.
Yeah, I think that's more like a short-term tax, correct? Uh,
Yeah. Yeah.
Let me ask you just some tactical questions. Who's the broker that you use? What is the charting solution to use? How does that work for you?
So I use Fidelity as my main broker. But I don't really do a lot of charting, believe it or not. I try not to. I don't use the charting system as much. I think a lot of people, they want to figure out moving averages and everything else. I try to trade more along the lines of the news in the market to see where things are from macro level and from a micro level with the company itself to see where there's opportunity. I think sometimes people get lost in the charts too much, and it's definitely valuable for some people, but it's not valuable for me. I do like alpha spread, however. alpha spread lets you look at the valuation, adjust your risk profile on there, so that this way you can see like what is your expected rate of return, and then map out in the future what a good valuation for a company should be. It doesn't always work. So that's not something, like if you're trying to like let's say a REIT, if you're trying to use traditional metrics to figure out what a REIT should be valued at versus a growth company, it's not going to give you that much of that good of advice. So you have to be very selective about how you use it. But in my opinion,
when you say short term, what is your time frame for a short term hold?
I would say probably a year to 2 years.
Okay.
Yeah.
That is a short term. So you don't do day trading. You're not in and out
No,
in the morning, out in the afternoon, less than a year. Okay,
no,
that kind of makes
no.
sense. That kind of
Yeah.
now
Yeah.
the charting and the lack of use of charting makes a lot of sense, because a lot of short termers who typically do monthly, weekly, daily, intra-day within sessions, they rely on charts primarily for a lot of their trading, right?
Yeah.
That's awesome. That is really awesome. Listen, it was terrific talking to you. It's a very
Yeah,
different,
of course.
approach.
Yeah.
Obviously, it has been a lot of experience that you've gathered over the years. The best way to get a hold of you is obviously on Twitter, I would imagine, or what are you doing
Yeah,
with
Twitter.
YouTube? Tell us about your YouTube.
I was originally doing more things around YouTube, but I work full time, so I decided to just kind of hang back a little bit. I am a guest on some people's podcasts that I typically do regularly. One of my friends, Amit, he's more into setting up things and promoting it out, and so I just leave that stuff to him, and I focus more on the Twitter side. And the amount of I just don't I don't I make more money doing what I do, and I don't feel like the amount of return that I would be getting by just creating YouTube videos is sufficient enough to like put in the time for it. I do, however, like having one-to-one conversations with people. Like, I don't know if you've dealt with this, Mukund, but I don't like looking at the camera. Like, I can talk to you all day, but I know some people, they have this thing where they can just talk to the camera for like 15, 20 minutes, even an hour, and describe things. And I can't do that. Like, I need to talk to a person.
Right.
Like, I can talk to you right now, right? If you tell me, Kris, do one of those YouTube channels where there's a guy explaining blah blah blah, what I just explained to you right now, if you told me to put in a YouTube video, it would be terrible. It would be terrible.
That's awesome. Kris, it was terrific talking to you.
Of course. Yeah.
Thank you so much.